Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So in today's video, we're going to look at 5 quality companies that are growth companies. We have been talking about growth companies, but we haven't actually mentioned that for a while. Now, we've talked about a lot of the dividend stocks and what you can do and ETFs and so on in the last few months, but we kind of stopped talking about growth companies. Remember, when we invested in the stock market, like I said, like the other day when we talked about your time horizon, you need to have a mix of companies. You need to have those companies who are mature companies. You need to have some of the growth companies. You need to have some ETFs, kind of mix everything together. So right now, it might be because everyone is basically fearful. Everyone is worried about, interest rates going up, inflation is going up, bear markets are coming up. Everything else basically seems to be going up when the stock market is going down. So at one point in the last few months, I had about 6,000, 7,000 gains. Right now, I only have 2,000. And a lot of that is because of the stocks certain stocks that I own, like Adobe, for example, which is a high growth business, is actually gone down quite a bit. Now, Adobe is not the only one. There's loads of different other companies out there. So what we want to know is basically, are there opportunities out there we kind of have forgotten about in the last few weeks? So we're going to look at 5 quality companies in today's video. So before we start, I want to talk about just generally the growth side of things. Okay, so Arc Innovation is basically tailored for growth companies that have no earnings yet, but in the next 10 years they're going to be, apparently, according to the company that created Arc Investment, they think these companies will be the best companies out there. They're going to solve a lot of the problems that we currently have. But when you look at a year to date, so for example, April of 2021 up until now. So if you even started investing in this ETF, right? I'm not saying it's Sharia compliant. I'm just saying I don't know some of the companies that are in there. I've never actually done a lot of research in it. But I'm saying if you had invested, you would have lost over 50% of your money right now. And a lot of that is because these companies have no earnings and they are high multiples. While that is happening, let's have a look at what's happened to the general market. So a year ago, okay, we are about 5% up. So this is the S&P 500. So these are the 500 biggest companies in the US, right? When you look at the Dow Jones, for example, and you look at 1-year returns, it's about 1%. So we're up 1% and 5% for the overall indices. But when it comes to the ARK investment, you lost about 50%. When we look at the QQQ, which is very similar to the ARK investment because they have a high beta companies or tech side of companies, you can see a year ago, we just flat almost. Okay, so the QQQ, which basically tracks the NASDAQ, is almost a flat. So if you had invested in this ARK Innovation, you would have lost quite a bit of money right now. But it's not a loss unless you actually sell these things. And that is the bit that worries me the most about new investors. Because what tends to happen is you see this thing going down. You bought it initially because maybe you didn't have a plan, or maybe you had a plan. If you had a plan, then stick with it. If you didn't have a plan, then you really have to now start having a plan, because this is the kind of thing that will happen in the stock market. I could lose half of this, okay? And my strategy is, if that happens, I'm going to look at the companies that I own and say, okay, Adobe is a quality company. The business model hasn't changed. Maybe people are not buying the product as much as they were before because of, they're prioritizing, basically eating before buying is Photoshop, right? Then I'm happy to then put more money into the business. So when things go back to normal, when the economic cycle changes, okay? So when in a bear market, most people tend to hold on to their money because there's a lot of money out there. Whereas in the last couple of years, we had the stimulus checks and all sorts of things. And for that reason, people were investing in the stock markets and they were making quick money. So they invested in this type of business. So what I want to say here is basically just be careful. Okay. Don't sell it. If you have a plan, okay, and your plan was to hold on to this thing about 5 years, 6 years, whatever, just wait. Even the lady, okay, Kathy Wood, actually says She always talks about 5 years time horizon. Okay, 5 years, that's what she talks about. So maybe give it a time, don't sell it. Anyway, let's get started with the video and then talk about these 5 companies that I think that could potentially be a good investment, or maybe they're not going to be a good investment. So let's see whether we should add to our portfolios or not. And the first company we're going to look at is one that you already know very well, NVIDIA. We've talked about in this channel quite a bit. So before we look at the company and basically what is going on, let's have a look at where it was about a year ago. Okay, so if you bought this thing about a year ago, you'll be about at least right now about 38%, which is very good. But in the last 6 months, okay, so a year to date, you're actually down about 30%. In the last 6 months, okay, you're only down 4%. Just this month, you're only down 14%. But a year to date, since January the 3rd of January, you've done about 30%. So if you bought it beginning of the year, or you bought it in December, you're down about 30%. Now, this is not the kind of company that you should sell straight away, because I genuinely think this is quality business. I don't know if I said this before, but I watched an hour and a bit of their, basically they had an investment, what do they call it? They have some sort of a show off about their products basically on YouTube. And that was about an hour and a bit. I genuinely watched the whole thing. And the fact that they're not just a company that creates like basically GPUs, for example, for gaming things, or the data centers, or all of that. It's actually a lot more than that. They're creating the hardware, the software, and their software is going to be software by subscription kind of thing. And they have the AI side of things, the basically autonomous driving, you name it, they are in it. Okay. In the next 5 years, not even 5 years, less than 5 years, I'm sure the market cap will be about $1 trillion. Okay. So it's definitely going to go up. But right now is a very high, high multiple business. So we just need to look at and be careful, because when you invest in, I watched that thing and I genuinely thought, you know what, let me just put £5,000 into this company and forget about it. It's easier to do that. But then I looked at the PE ratio and I'm like, okay, hold on a second. Just be careful. Okay, we're looking at PE less than 20, and we basically you want to buy it when it's basically 55 PE. Anyway, let's have a look at it. Current price is $212 per share, PE of 55. Price to free cash flow here is 66. Okay, so that shows us it was quite expensive. And EPS only 3.85. Like I said, market cap is just owned by $600 billion at the moment, but I believe this is going to go up in the next few years. That doesn't mean you should buy it straight away. Okay, let's look at the financials. Economic mode is basically, it has a wide mode. Capital allocation exemplary. What this means is basically the company is actually utilizing the money they get, okay, from the revenue and all of that stuff. They actually reinvest in the business. The management are doing very good job of doing that kind of thing. Annual dividend yield is just, it shouldn't even exist, to be honest with you. 5-year growth rate is 6%. Dividend growth streak of 9. I would be happy to buy this company and don't get paid dividends, but I hope they start increasing, maybe get to about 1%. That would be really nice. Dividend growth streak of 9 years, and payout ratio just 4%. Just 4%. They can increase that as much as they want. And dividend safety of 89, which is very safe. They have free cash flow of $8 billion in the bank. Beta slightly high, but current ratio perfect. So you've got nothing to worry about. Profit margin, we're looking about 15%. Now it's 36%. Same goes again for the return on equity. And then when you look at this is the reason why people are paying higher multiples. Quarterly revenue growth of 52%. Quarterly earnings growth of 106%. Okay, so this is based on last year. So again, things can change this year, right? Next 5 years, the expectation is this business or the earnings to grow about 31%, which is really, really high. Then when you look at the valuations, Simply Wall Street says basically is overvalued. This should be actually red. So I'm going to change that now. So that should be overvalued at the moment. Price should be 184. Morningstar says it's fair valued. It should be a target price of 200. TipRank says it's basically 60% upside right now. And the price should be $341 per share. In my opinion, it's a hold. I would love to buy this business, okay, below 200. If it goes maybe 180, 120, I keep changing my mind because I want that safe, margin of safety. Because remember, if you put £5,000, like I said at the beginning, on this business, and it never recovers, because there have been stocks that, like for example, Cisco, in 2000 or 1999, the price was, I think, about $80 or whatever it was, and Intel, they were about $80 per share. They've never gone back to that level. Genuinely have never, ever gone back to that level. Okay, they are right now trading about $45 to $60 per share. They were up at least 80. So people have lost money and basically made peace with it. So that kind of thing, it scares me. And that's the reason why I want to be careful. So when I say these things, I'm not just saying it. I genuinely mean it. Okay. So the next company we're going to look at is Zoom. Zoom is one of those companies. Okay. When year to date, it's only down about that. But when you look at a year ago, this time is actually up quite a bit. Oh, actually, this is NVIDIA. Sorry. I was wondering what's going on here there. So a year to date, so a year ago, this is down from a year ago. So this time last year, the price was $324 per share. Right now is only $110 per share. It lost 66% of its value since then, the price wise. The business is still fine. Is the basically the business, actually, I'm not sure it's fine. We'll find out in a second. But when it comes to the price, it's actually lost quite a bit. 40% down this year to date. Last 6 months, about 60% down. Last month, it's not down actually, it's flat. And then just last a couple of days. So again, this is another business that have seen a high valuations early on. Everybody was buying, including myself. I actually bought it, made a little bit of money, and then basically took my money and put it somewhere else. So there was one day where it basically shot up. I bought it a day before, and then on the following day actually went up, I think 20% or whatever it was. It wasn't a lot of money. I took my money and then sold it straight away. So it does happen. At the time I had a little bit of money in the account, so I thought, you know what, let me just see what happens, and actually made a profit. I could have lost a lot of money, to be honest with you. That was just stupid of me. Right, so this company has lost quite a bit. In terms of financials, let's have a look. Okay, so current price is 110, PE 24. This is not bad. And when you look at the price to free cash flow, this really surprised me because it's gone down quite a bit. Okay, let's have a look. This company, if it was trading, say, basically a year ago, 326, it might never, ever go back to that price. Just like Cisco and Intel were in the 1990s, it might never go back to that price range. Okay, and that's the scary part about investing. But right now, I'm really surprised that it has a lower multiples. EPS 4.5. Again, that surprised me as well. I didn't think they have a positive earnings. Market cap, okay, you've got about $33 billion. Economic mode is narrow, and capital allocation is basically standard. Free cash flow $1.4 billion, which is really good for a growth business. Beta quite high. Current ratio really good. We're looking for anything above 1, so that's perfect. Profit margin and return on equity both positive, and not only that, they're actually quite good. And then when you look at the revenue growth in the last year and earnings growth, they're really good. Next 3 years, basically 3 years, they're expecting this to grow about 13.6%, which is decent. Okay, which is not bad at all for stock that's trading right now about 24 multiples. Not bad at all. Simply Wall Street says undervalued. Price should be 138. Okay, and then you've got Morningstar, the same thing again, and it says 160. Morningstar is actually a lot more bullish than Simply Wall Street. And I realize that happens a lot when it comes to higher multiple stocks. Okay, Simply Wall Street is actually a lot more conservative, if you like. And then you've got Trip Ranks, which is basically says about 50% down at the upside. Price should be 162%. Okay, that's not bad at all. And then it's a buy. Now, I say it's a buy, but what I will do if I was interested in this business, obviously, I would look at the whole business. Okay, not just the stock and basically how the current stock has actually gone down quite a bit and they've been beta, whatever. You have to think about this part here. This is important for me. Why is that important? Because anybody can come up. Cisco has its own video conference software. Other companies can just add as their part of their business. Microsoft has it the same thing. So will this business be around another 20, 15 years? I don't know. And that's the bit that scares me about the business, okay? So it's not about the numbers here. It's all about the business model. So their business model is quite vulnerable. So you have to be careful with that. Next company we're looking at is CrowdStrike. And just let's have a look in terms of the numbers and in terms of the stock, right? So year to date is actually up. This is probably one of the only ones in this short list that's actually up 18%. I was really surprised. I had it very, very small. I think I had a half a share. I sold it a few months ago. And this is the only, probably one of the companies that I will own at some point. Right now, I will tell you why I shouldn't own it, basically why I'm not adding to my portfolio in a second. But when you look at the 6 months, it's down about 17%, whatever. But you have to take into consideration the fact that a year to date, okay, so since January is actually up about 18%, almost 19%. A year to date is about, a year ago, so years from now, this time last year, basically, you got about 10% up. And then in the last 1 month, it's up 15%. So it has recovered. At one point, it was trading about $200 per share, and then it has actually kind of gone up since then. Right, so let's have a look at the financials. Again, it's in the tech company. It's a tech company. It's a cybersecurity company. And I think this is one of the businesses that's going to benefit a lot from what's happening right now in the world between China, China and the US and Russia and Ukraine. All of these things that's happening, a lot of companies and countries are basically tightening their security systems because now people are trying to hack into each other's systems, whatever. And CrowdStrike is actually in a very good environment. They have so many companies in the Forbes 100, I think. They work with so many companies in that sector, basically in that list. Currently trading $235 per share. There's no PE because they are not making money right now. They're actually losing money. There's no price to free cash flow yet. But currently this market cap is $54 billion. It has a narrow economic moat, but when it comes to capital allocation, it's actually quite good. Free cash flow, just about 400 million. So it's not a lot there. Beta is actually above 1, so it's quite volatile. Current ratio above 1, which is good, so they have enough to pay off. And then when it comes to this part, there's is non-existent at the moment because they're not even earning money. But they're getting closer because I was reading an article. In fact, I can show you very quickly. In CrowdStrike, 5 billion of revenue by 2025. That's about 3 years from now. So if you buy these products and actually hold it for the next 3 years, okay, not only is it going to go positive, right, it's going to make about 5 billion. And 5 billion, right now, I don't know exactly how much they're making, but that to me is a good news. It's heading actually the right directions. In fact, you just need to look at the current revenue and compare it with that as well, okay? A lot of these companies are down because of the high interest rates. They can't go to the bank and get 0 interest rate for whatever and then use that to build the business or whatever. So it's basically, for the growth side of things, it's becoming difficult for them. But when you look at the next 5 years or next 3 years, it's about to grow about 50%, which is very good. Simply Wall Street says it's about 37% undervalued at the moment. Price should be $372 per share. Morningstar, kind of similar situation, but $225 per share from where it is now. So it's not undervalued, but fairly valued at the moment. Tip rank is actually a little bit bullish, but $275 per share. For me, this is a buy. Okay, so I don't think it's a strong buy. So this is based on a tip rank, but I would say it's a buy for me now. But if I was to purchase this, I'll probably wait. Okay, I wouldn't add it right now. I will wait until it goes below 200. And to be fair, it has happened in quite a few number of times. In fact, February, 23rd of February, it was actually $161 per share. $156 per share, March, the 8th of March. Okay, and since then it's actually gone up 50%. 50%, can you believe that? So it's doable and it can happen. So if we can get into the situation we were in March, February, you might actually be able to get this stock under 120, 150, 160, 170s. Even if it's below, as long as it's below 190-ish, I think I will probably starting a new position. The next company we're going to look at is Tesla. You know a lot about Tesla. I don't have to talk to you about it. They're probably one of the best companies out there right now. But the only issue I have with this company is just the valuation. Okay, currently trading $985 per share, PE of 200, price to free cash flow of 315, and an EPS almost a 5. Okay, market cap of over $1 trillion, economic mode is narrow, and the capital allocation is absolutely excellent. Okay, free cash flow 3.4 billion, almost $3.5 billion. Beta is very, very high. Current ratio above 1, which is good. Profit margin of 10%. Okay, we're looking about 15%, but it's only 10% right now. Return on equity just 20%, which is above what we're looking for. And then when you look at the last basically 2 quarters, or basically last comparison to a year ago, okay, so this time last year basically they're up about 65%, 760% almost there. And the next 5 years, the analysts are expecting this company to, or the earnings to grow about 37%. Now, this is the reason why everybody is actually happy to pay these multiples. Okay, and that is the one thing that worries me about this stock. A friend of mine has actually got I think he's got like £16,000 in there. Like, you know, I was talking to him today and he said, oh, he took about £4,000 profit just to basically to be on the safe side and invest in another company. And I thought that was absolutely brilliant idea. Because if you own this kind of company and with these high multiples, you never know what's going to happen. So to take profit off the table is not a bad idea. But if you basically if you have the stock already, okay, you might want to hold it for now. Simply Wall Street says is basically way overvalued. The price should be half of where it is right now. According to Morningstar, it's a similar situation. It should be about 700. But the only one that's bullish is TipRanks, and it says about 2% upside. It should just be $1,006 per share. I personally think is a hold. Okay, if you want to take profit off the table here and there, do it. I've sold it out completely. I don't own it anymore. If it goes down to evaluations and lower multiples than 200, I will definitely look into that, adding to that to my portfolio. But right now, it's definitely a pass for me. I wouldn't add into my portfolio. The next company we're looking at is Shopify. I'm sure you know what the company does. It's sort of a basically online business where other companies and smaller companies can actually advertise their products and so on. When we look at the price of this, so when we look at this, okay, so let's go to year to date. So that's about 60%, 58% down from a year to date. And then when you look at a 1 year ago, is down about 50%. Last 6 months, down 60%. Just this month, about 11%. Last 5 days, about 10%. So the company at one point, so if I go to max, okay, one point was trading $1,690 per share. They must have done a split. No, that can't be it. Wow, 65% down. Okay, because I don't follow this stock as much, I'm really shocked where it was and where it is right now. It lost to 65%. Wow, that's crazy. So let's have a look at the numbers now. So currently trading $579 per share. PE is quite low. Price to free cash flow is actually quite high. EPS of 22.88. Market cap of $72 billion. Economic mode is narrow, so they don't have a competitive advantage. Another company can come in and change the business if they wanted to. Capital allocation is just a standard. Free cash flow, just about half of 4.53 million. And then you've got beta of 1.62, so it's basically higher than 1, which is basically means that it's quite volatile. Current ratio above 12. Wow, that's really good. Profit margin 63%. Return on equity 33%. Growth in terms of quarterly revenue growth 41%, and this is probably one of the reasons why people are paying high multiples. And then when you look at the next 3 years, it's about 38% growth in the next 3 years. So that is really good, and that's probably why it's trading at higher multiples. But 25 is not bad at all. 25 is not bad at all, right, for this type of business. So when you look at Simply Wall Street, it says overvalued again. Sorry, this one should be red. So overvalued about 16%. Target price of $400. It's about $500 per share, and we're seeing it currently trading for $579. When you look at Morningstar, similar sort of situation, but it should be about 730 30, so not far from where it is now. It's actually quite good. Okay, Morningstar being bullish on this. Okay, that's interesting. Tip ranks is 72%. The tip rank is crazy. They're saying it should be about $1,000 per share, and it's got 72% upside. It's a moderate buy. Code based on this information. Again, what worries me is I don't use their product. I don't know much of the detail, the ins and outs. But as based on what I've read so far in their earnings report, I had a quick look in their earnings report. It looks like to me there's other companies that can do similar sort of things. I don't know if they monopolized that market yet, and if they have, basically this would have changed to a basically wide whatever. So yeah, so I'm not really sure about a lot of basically where this company is heading. If I was really interested, what I will do is look at their financials, look at the companies out there that's very similar, they look at their competitors, and then make a decision based on the next few years. But maybe wait for a better valuations. Maybe when basically the price to free cash flow comes down a little bit and the PE comes down a little bit more, that kind of thing. So for me, it's just a hold if you have it already, basically a moderate buy if you're really interested, but I will just do maybe 2-3% here and there. I wouldn't actually put a lot of money in there. Now that's my take on these 5 amazing companies, okay? And remember, this is just my opinion and based on the research that I found, what I think about these businesses, okay? It doesn't mean it's right, doesn't mean you can go away and invest in these businesses. You just have to do your research. The ones that I'm really interested in, you probably will end up seeing at some point in my portfolio, I'll be honest with you, NVIDIA, okay? No Zoom for me, CrowdStrike. So those are the out of 3, okay? Or 5, sorry. Those are the 2 that I would like to add to my portfolio. Definitely Tesla if it comes down. I used to own it before, but I did it as a trade. It wasn't long-term investment, so that's the reason why I did it. But if it comes down a bit and obviously the numbers start improving and everything starts ticking up the way I want, then I'll probably add to my portfolio. I know this is probably one of the longest video I've done, but I hope you enjoy the videos. I just want to give you a general perspective where the markets are currently, what's happening in the markets generally in the last few months, okay, as well as that, just to kind of show you some of the companies out there you could potentially, especially if you're young and you basically got like 15, 20, 30 years, or even more than that time horizon, maybe the NVIDIAs should be the companies that you should invest in. Maybe the CrowdStrike, maybe the Teslas, once you've done your research and you know about these companies. I'm going to do another video at some point next week, just looking at another maybe 4 or 5 companies that are in similar sort of situation, because I've realized we've kind of ignored that sector, basically the whole growth side of things, and there's so many companies in there that are really trading like basically lower multiples than they were about, say, a year ago. Okay, so we'll look at those companies next week, inshallah. Have a wonderful day. Assalamu Alaikum.